Yes, a very good morning and many thanks for staying with us right here on NTV Uganda. My name is Rami Bisika and I come to you with a very pertinent conversation. Rebuilding financial resilience in a post-COVID-19 world, a capital markets perspective. We go back to 2020 during the onset of the COVID-19 pandemic, March 20th, 2020, when we instituted a lockdown. Many individuals, business owners and traders and so forth thought that the measures that were instituted back then would be short-lived. But guess what? A year later, we are still grappling with the lockdown, and another has been instituted, an inter-travel ban. So in the last 1 year, we do know that the COVID-19 pandemic has wreaked havoc on personal finances over the past year. Without, in a country that isn't having universal medical coverage and with residents or citizens who are only covered by medical insurance, only 1%, you do know a relative or a family member who actually sought help from you or another member of society because they couldn't cope up. Some of them had to just go deeper into their personal finances or savings to actually make a living or deal with the financial impact of the COVID-19 pandemic. So in that respect, we want to know the role of the capital markets in actually helping us build resilience in this post-COVID-19 environment. But we shall largely first tackle the impact of COVID-19, yes, from 2020 up to now, and what we need to do to ensure that we build resilience in a post-COVID-19 environment. I have 4 panelists, yes, very intelligent panelists. One of them is Sarah Katuramo. She is an investment analyst with Gen Africa Asset Managers. We are also joined by Mr. Ayiko Ongodia. He is the CEO and founder of Zeno Investment Management Uganda Limited. Online, we have Mr. Dixon Sembuya. He is the head of research. He is the director of research and market development that is at the Capital Markets Authority. Very good morning, Mr. Dixon Sembuya. We also have someone from the Bank of Uganda, the head of reserves management, and that's none other than Mr. Alan Retebe, with whom we shall be compounding more on the impact of the COVID-19 pandemic, largely within 2020, and what is being done to ensure that we build resilience so that our citizens actually come out of this very, very bad situation of quagmire. Well, let's kick off with Mr. Ayiko Ongodia. He's already with me here in studio so that he can actually answer for us a very, very easy question. What are capital markets? Very good morning, sir. What are capital markets?
Very good morning. Thanks for having me in the studio. So capital markets is very simple. It starts with capital. So generally in an economy, there is people generally that save up a bunch of savings. They might put them in the bank, they might put them in an asset. Then there's entities that need to undertake an enterprise, but in order to undertake that enterprise, they need working capital of sorts.
All right.
So they go and typically borrow from the savings of that economy in order to undertake that enterprise and then pay back and possibly plus interest. So what happens is the capital markets generally is where these net savers are matched with entities that require borrowing that capital. So generally capital markets, you'll find stock exchanges, you'll find money markets where short-term instruments are issued and traded. You'll find bond markets where medium to long-term bonds are issued, are traded. So generally capital markets is where you match net savers who want to convey their savings to an entity that wants to borrow them or that wants to take them in terms of equity.
Indeed.
So that they are intermediated. So capital markets intermediates capital from net savers to entities that need to use it.
Indeed. Mr. Ayiko Ongodia comes with a wealth of information. He is the CEO and founder of Zeno Investment Management Uganda Limited. He's part of the 5 licensed CIS managers that we have in Uganda, courtesy of the Capital Markets Authority. Speaking of the capital markets, Mr. Ongodia, I would like to know, how can these capital markets be used to build up the resilience needed to actually protect ourselves from these financial shocks that are brought about by COVID-19, to cover financial losses and to accelerate growth of savings?
So the thing is, generally as an individual who is engaged in an economic activity,
Indeed.
you earn an income either from your job or from your business. So a combination of the two. So the first thing that you do as an individual is to earn some money. Then your mom told you that typically when you earn some money, you need to save some of it. You don't consume everything that you've earned. Save some of it. But very, very importantly, the professionals will tell you that your savings, if they are not invested, they will be eroded. The value of those savings will be eroded over time, one, by bank charges, for example, and then two, by inflation as well. The value of 1 million shillings in Jan is different from the value of 1 million shillings in December, because 1 million shillings in December buys much fewer units of goods than 1 million shillings. So what capital markets do is to move those savings through time efficiently by putting them to work and generating a return on those savings. So there's various ways to move those savings through time, but the capital markets are by far the most efficient ones to move. And when I say move through time, it's essentially you want your savings, you have your 1 million shillings in Jan. You want to move it to December. The best way to move it to December is not to put it in a... you could put it in a bank, you could put it under your bed, or you could put it in a bond or a financial instrument. With a bond and financial instrument, it more than likely generates a higher return for you to end up with more than 1 million shillings at December. Same, if you want to move these savings from now to till your retirement, you could put them in a bank or under your bed, but more likely you'll get a much more efficient return, a much more maximized return if you put them through the financial markets.
Of course, Zeno Investment Management Uganda Limited is one of the 5, licensed collective investment scheme managers within this country. They are licensed, so if you need any help, just go to Mr. Ongodia Aiko. He'll be able to help you invest that money. We also do have Sarah Katuramo. She is an investment analyst with Gen Africa Asset Managers. She also comes with a wealth of information. Sarah, would like to know, paint for us a picture, the relationship between the Capital Markets Authority, where Dickson Sembia hails from, and the CFA, Society of East Africa. And why is it so important to us? Okay.
Thank you so much for having me. Just to give you a bit of context, CFA Society is it's an association of investment professionals. They promote the highest ethical standards in the industry, and they also work together with local communities to educate the masses on how investments work, and where you can put your money, and how the entire industry works. So given the situation that we were in, and the fact that the Capital Markets Authority had signed an MOU with CFA maybe in 2017, they agreed to work together to educate the masses on how the industry works. Now, we all know the situation that we're in and how COVID has devastated us. Everybody has lost lives. People know people who have lost loved ones, people have lost businesses, people have lost jobs. So what the CFA and CMA have done is come together to tell us, in this situation, we need to learn. We need to learn from each other. We need to learn how to adapt. We need to learn resilience as we try to forge a way towards rehabilitation. So again, given the current situation, what CMA and CFA did was put together this much needed discussion to give us a capital markets perspective, as we've seen, as Ongodia has started to paint out, to give us a capital markets perspective on how we can try to rebuild as we work towards recovery. All
right, that is Sarah Katuramo, an investment analyst with Gen Africa Asset Managers. Let me also bring in Mr. Dickson Sembia from Capital Markets Authority. He is the Director, Research and Market Development. Let's talk about the investment clubs and some of the work they are doing. I was reading some literature, courtesy of you, Mr. Dickson Sembia. There's a literature that you put up that was in 2020, and you were talking about investment clubs doing business on their own. They have their own leadership, whereby they actually invest money using their own investment clubs. But then you are calling on to them to actually embrace the collective investment scheme, because here, since these investment clubs are having members who are so busy on a daily basis, and the CIS is run by a program manager or a CIS manager, it would be a better deal, Mr. Dickson Sembia. Can you hear me, Mr. Dickson Sembia?
It would be a better deal, Mr. Dickson Sembia. Thank you for having me. Good morning, viewers. I'd like to start by thanking my colleagues, Ayeko Ngodia and Sarah for paving the way for me.
Indeed.
Now, talking of collective investment schemes, or what we call CISs. Now, I'd like to unpack what a CIS or collective investment scheme is. A collective investment scheme is a pool. Okay, so you have a pool where I, Sarah, Ayeko, we contribute money, and this money in the pool is actually invested on our behalf by a professional who is actually licensed by the Capital Markets Authority. Okay, so we pool our money together, and this particular professional who has studied markets, who has a lot of knowledge on how markets work, financial instruments, takes our money and invests this money on our behalf. Before I even go further, I think I'd like to recognize, the saving spirits that, Ugandans have embraced when it comes to investment clubs. I think we've seen investment clubs come up of different sizes. And, this is actually helping in cultivating that culture of savings among our people. Now, turning back to collective investment schemes, there are quite a number of merits or advantages that come as a result of investing in collective investment schemes. Once you pool funds together, you actually get to enjoy economies of large scale. You actually get to invest in financial instruments that you as a person or as a single individual might not be able to invest into alone. And therein lies another advantage, which is diversification.
Yes.
This is a large pool. Okay, this is a pool which is enjoying economies of scale. So whoever is managing the pool for you can actually be able to invest in so many instruments, hence helping you diversify. And in finance, you're always encouraged to diversify. You're always encouraged to put your eggs in different baskets as a way of managing your risk. So once you invest in this particular pool, and once you have this investment professional investing for you, he gets to invest in so many other financial instruments, hence helping you diversify and minimizing your risk. Then I think you alluded to an article you read that I authored.
Yes.
And I'm very glad that you're reading this and it actually has an impact.
Indeed.
Part of the problem that I highlighted in that particular piece was the fact that, as an investment club, I was using the case of investment clubs.
By the way.
I belong to about 2 of them. As members of an investment club, we are very busy. We are busy people. And so we have very little time to actually sit down and engage in the day-to-day management of whatever it is that we have saved as members. So once you invest through a collective investment scheme, this particular investment professional will actually be able to do all that on your behalf. So it takes away that headache of having to manage your funds on a day-to-day basis. The professional will do that on your behalf. And another sweetener in as far as investing in collective investment schemes is concerned, collective investment schemes, once they distribute income to members, the income distributed to members is actually exempt from income tax. So that means that you actually get a higher return once your collective investment scheme is able to generate a return, owing to the fact that they are tax exempt when they distribute the returns or income to members.
Zambia, can you hear me, sir? We also do know that the savers with this scheme, the collective investment scheme, can actually withdraw their funds when they feel like. They can sell their units. Mr. Dixon Zambia. Actually, the investment clubs have their own leadership, meaning if they choose not to go for the CIS.
That is the other beauty about investing in a collective investment scheme.
Yeah. Yeah, frozen.
Absolutely.
The investment clubs have their own leadership, meaning.
Okay. Talk about the sweetener, the fact that the savers can actually withdraw their units. They can sell them to the CIS manager if they want to opt out of the CIS scheme. All right, I'm afraid we have lost Dixon Sembuya, the Director, Research and Market Development at the Capital.
Is one of, again, the major advantages of investing in collective investment schemes.
Dixon Sembuya, the Director and Market Development at the Capital, is one of
I seem to be getting a bit of feedback. I don't know if you can repeat the question.
We wanted to know the beauty of the fact that most of these savers who are under the collective investment scheme, they can actually sell their units to the CIS manager and get their money back in form of cash. Dixon, if you can hear me.
Like I was saying, you've hit the nail on the head.
Indeed.
One of the beauties about investing in a collective investment scheme is the fact that investing in these particular instruments afford you what we describe as liquidity in this part of the world or in our profession now. When I talk about liquidity, what I mean is that you're actually able to convert your investment into cash.
Indeed.
Very fast and at a very low cost. So collective investment schemes are considered to be very liquid. And usually once I need my cash back, normally within 24 hours, I'm actually able to get my cash back. So collective investment schemes have that particular aspect of liquidity or attractiveness, owing to the fact that you can change your units into cash very fast and at a very low cost.
Yes, Sembuya, he is the Director of Research and Market Development at the Capital Markets Authority. We also have a representative from the Central Bank, and that's none other than Mr. Alan Rweteba. He is the Head of Reserves Management at the Bank of Uganda. Mr. Alan Rweteba, let's talk about how the COVID-19 pandemic has affected the economy in that regard and how it has impacted on the resilience of the households within this country. I was reading some literature, and it actually contains that, yes, 1 in 3 relatives in a family couldn't come up with 115,000 Uganda shillings for an emergency within 7 days. We're talking about only $30, meaning the impact of this COVID-19 pandemic on our families has been dire. But has it persisted, and how badly? Alan? Alan Rweteba.
Good morning.
Yes, sir.
Romeo, good morning, everybody. Thank you for hosting us. For the questions you've asked, I wish to place a caveat on this, my response. I'm not speaking today as a representative of the Central Bank.
Okay.
I am speaking today as a member of the CFA Society East Africa, where I am a board member. But I'm able to share my professional perspective on what I've observed over the last 15 or so months. What we have seen since March 2020, we've seen many individuals, households, families. We've seen breadwinners lose jobs. We've seen individuals experiencing a reduction in salaries. And of course, we've all had to live. Over the last 15 months, we have had to live on our savings, draw down on our savings to fund healthcare, to fund education. As you may well be aware, Romeo, most of our children have been studying online using Zoom and other such methodologies for education. That is very expensive. We've had loved ones spending weeks in hospitals. That has taken a drain on a lot of individuals. So there has been a lot of impact. So a lot of savings have been drained as individuals have sought to live and manage through the pandemic over the last 15 months. What we see is that individuals, we used to guide individuals that they need to have at least 6 months worth of living expenses. That was the guidance we used to give a lot of individuals we advised. 2019, that was correct, because the expectation was that an individual would lose a job, take at least 6 months before they get another job. And so the expectation was that in terms of saving, one was fine if they had 6 months worth of living expenses. We have seen over the last 15 months that that was a misconception on our side. That was weak in terms of advice. What we are seeing is that we need to change and give new advice to individuals, to families, to households on how they need to build up their resilience. Our guidance now is that there is a need to revise from 6 months to at least 36 months or 3 years worth of living expenses. You should be able to calculate or estimate how much you spend on a monthly basis and maintain as an emergency fund money equivalent to 3 years worth of your current living expenses. That should be something that then we should take forward after in the post-COVID environment, because we can clearly see that if there is a crisis, it will take much longer than previously anticipated. A crisis can take more than 2 years. And if that happens, most individuals will fall back into poverty unless they have strong safety nets. And so our discussion today is to bring this to attention to the public, that there's need to revise our saving structures. There is need to revise the savings of households. We need to keep more money aside for emergency purposes, but also in anticipation of such disruptive events as similar to what we have seen with COVID-19. And so our guidance as professional money managers is that the public, the general public, needs to adopt new measures of resilience. And the CIS, the Collective Investment Scheme, is one way. You also mentioned investment clubs. That's another good avenue through which individuals can come together, pool their resources, and start to rebuild their lives. Investment clubs are a good avenue for raising money capital, which capital can be used to start a new company, a new farm, a new business idea. CIS are a good avenue for an individual or a family to slowly build back their savings. But as I've guided and I've mentioned here, we need to be focusing on keeping at least 3 years or 4 years worth of living expenses going forward in terms of helping us to have a good foundation.
Mr. Alan Wetaba,
that will help us build up our resilience as we go forward.
Mr. Alan Wetaba, the FSD Uganda also conducted a study, and it indicates that 1.8 million traders, mostly women, might not go back to pre-pandemic economic activity, pre-pandemic levels of economic activity. How dire is this situation now that we are talking about an inter-travel ban on movement? There's a lag there, just a few seconds.
Thank you, Romeo, for that. That's a very difficult question. And it's a very difficult situation that a lot of women and women-led households find themselves in. A lot of the jobs that were heavily impacted with the strict lockdowns were mostly managed or influence the earnings of women. And we see this in the markets. We see this in inter-district travels. We see a lot of women doing a lot of the work that was impacted by a limitation on travel or movements in 2020. And this has impacted a lot of households, especially the households that are led by women. And we are likely to see this effect continue, because it's not as easy as turning off a tap. If one has lost their source of earnings, there is a process, there is time that takes for them to build back their ability to manage their business again. So a lot of these women-led households and women-led businesses will need a lot of support. And the reports that you highlight from FSDU is very critical in allowing us to understand the magnitude of the problem. But where I sit as an economist, I anticipate that the problem is significant, and we need to design specific interventions to provide money, to provide capital to the women-led businesses and households to allow them to kickstart or restart their economic lives, because that is how we will be able to build back individual resilience, but also country-level resilience. So it's an important aspect that we need to be thinking about. We cannot fully discuss it in this 1 hour session, but I believe this is a matter that a lot of other regulators and authorities are really picking up and are designing interventions in that line. The Capital Market Authority has recently signed an agreement with the FSDU and the EU in Uganda. It's called the Deal Flow Facility. And this Deal Flow Facility is going to be targeting to develop and harness, grow SMEs, young businesses, innovators, and allowing them, providing them with the capital they need to survive the 3 early years of a business growth. And this Deal Flow Facility is going to be very pivotal in allowing the economy grow back and grow back better, in the words of President Biden. Thank you very much.
Wait, he is the head of reserves management at the central bank, that is Bank of Uganda. Many thanks for that submission. Let me also bring in Mr. Aiko Ongodia. He is the CEO and founder of Zeno Investment Management Uganda Limited. Now, Mr. Ongodia, here's another study that was conducted by FSD Uganda. Now they said the risk of over-indebtedness might increase. Over 15% of the respondents who were surveyed, they say that they actually did borrow on digital apps. And 23% of those same respondents couldn't pay the money within 14 days. So the risk of over-indebtedness seems to be increasing. The fact that people are borrowing more than they are saving. And on the show here, we are telling them, please, save more with the CIS or with the investment clubs. But then it seems like people are borrowing more and more and more to make ends meet. So essentially, when we say financial resilience, what exactly do we mean? And how can the investment industry help us build the same resilience?
Thank you. It's perhaps interesting to complete the sentence.
Indeed.
Build up resilience against financial shocks.
Indeed.
Yeah, so that's the context.
Indeed.
Yeah? So every individual experiences shocks. Your aunt gets sick, you know how it is in Africa. Your aunt gets sick. Your aunt gets sick and you're asked to pitch in.
Indeed.
Your mom gets sick and you're asked to pitch in.
Indeed.
And so we do know that, again, I will just stress this back, you earn some income, you save some of that income, but very, very importantly, you need to invest that income.
Indeed.
But our perspective, and this is what we do at Zeno, help individuals execute a goal-based investment strategy. Help individuals, first of all, plan, save and invest for specific goals. So I say goals because every person has different goals. There's emergencies, there's medical, there's building a house, there's retirement, there's taking a child to school. All of those things that are listed there, many of them take place in the future. And so in order to be able to finance those goals in the future, a lot of the time you actually have to actively save, but very importantly, actively invest those savings for those future goals. So it is just identifying what are these possible goals. When we're talking about what are these possible goals that we will need resources for? And instead of thinking, okay, those goals, taking a child to university, I'll use my future salary to do that. It might make sense to start saving some of your earnings right now and investing those savings towards that goal, rather than 5 years down the road, 10 years down the road, anticipating income, anticipating income, which you might or might not have, or even if you do have, you might or might not be enough because university education or anything like that will become increasingly expensive. So in terms of building resilience, is think of your future goals. What are these? Of course, you'll need, like Alan had said, you need some money for emergencies. You'll need an emergency fund. But you might also need an education fund. You might also need a retirement fund. You might also need a house fund, so to speak, or a medical fund. There's many ways to do. So just breaking. So this is how, and this is how the capital markets can help. And so once you put aside those savings, you've sort of, and we typically do this at Zeno, we help you sort of break down those goals and then estimate for you how much you need to save. Of course, the goals are many, but there's a very neat way we can sort of break it down and say, for your retirement, save this much. For your emergency fund, save this much. For your child's education, save this much. So you have different pots, so to speak. And then deploy those pots in financial instruments in ways that are appropriate for those specific goals. So those are some of the steps. In fact, we're doing some work with the FSD Uganda, as you mentioned, to essentially focus people not so much on the returns that they generate from these financial instruments or the capital markets or whatever, or these businesses, but focus their minds on the goals that they will need to meet in the future, and then save slowly towards those goals.
Very pertinent conversation we are having on how best we can rebuild resilience in a post-COVID-19 environment. We're talking about a capital markets authority perspective. I have Ayeko Ongodi, I have Sarah Katuramo, I have Dixon Sembuye, and I also have Alan Reteba. 4 panelists with whom we are expounding more on this conversation. Sarah Katuramo, let's talk about some of the assets that are available within the financial markets where one can save where one can invest their savings.
Okay.
Yes, what are some of those assets in the financial market where I can, as Romy Busiku, invest my savings?
Okay. Just because I, at the risk of sounding like a broken record, I will not get into the collective investment schemes.
Yes.
These have been touched. So I will just give you...
You could briefly, because we are trying to woo the people from the investment clubs, you know, to forego the fact that they also have their own leadership, they can expedite their own business activities or modules, but then they could go for the CIS. As Romy Busiku, I could be busy with this show, and I can not, you know, undergo that business activity, but then I can go for a CIS manager who can handle the business on my behalf.
Okay.
Go ahead.
So since they had
Let's move
mentioned that the collective investment schemes pool funds from different investors, people who can put aside some little money, they pool funds and then invest in the, I'll give an example, the traditional asset classes.
So why should they go for them?
I'm just going to briefly touch on which asset classes these are.
Yes.
So they can invest in either the debt market or the equities. So for debt, they can buy bonds from government, as stated as government securities. These bonds are either on the short end or the long end.
I see.
So depending on your need or depending on where the yields are at the time, if you need to, you know, lend money to government for a short amount of time, you can invest in treasury bonds. Yes, and these have tenors of about 3 months, 6 months to a year. And then the bonds have tenors of about 2 years, 5 years, 10, 15, and 20 years currently. The equities market on the Ugandan Securities Exchange, we currently have about, I'll say, 17 stocks, 9 of which are domestic companies, and then 8 are cross-listed stocks. So all these are different assets that the collective investment schemes do invest in. And then just a little, just for me to touch on other assets that are available, although not too common in our market. We also have corporate debt. Why I want to highlight this is because it could be important for business enterprises to have a different option of non-bank financing. So they can issue these papers which are termed as, we have commercial paper and we have corporate bonds. The commercial paper would help you service short-term funding needs. Let's say you're a business and you're trying to raise money for your working capital. You can issue commercial paper and be able to borrow cheaper than you would from the bank.
Yes.
But you're borrowing from the markets. This is why it's very important for us to save, because you're not only helping the individual, you're also helping the broader economy, these businesses as well. And if they have, let's say, a new project or a new product line that they are trying to finance, they would issue corporate debt. And these are the longer term tenors of the bonds.
All right. Let me also bring in Mr. Dixon Sembuye. He is the Director of Research and Market Development at the Capital Market Authority. Mr. Sembuye, a very good morning once again. We'd like to know to what extent does the investment regulator, we're talking about the Capital Markets Authority, actually go ahead to support the individual's efforts to build resilience at the personal level? How does the CMA, yes, help the individual build resilience at the personal level?
Good morning once again. Thank you again for having me on, and thanks to all my colleagues for, breaking down and, unpacking some of these concepts that, members of the public at times find that it will be difficult to, grasp. But I think before I go directly to your question, just allow me to also unpack a few terms. And some of the terms I'd like to unpack include a bond. Okay, a bond is simply a loan from an individual to a company. And so once you give this loan to a company, in return you get interest. And at the end of the term of that loan, you get back your principal. So my colleague Sarah, when she talked about government bonds as an example, she simply meant, members of the public lending to the government and in return getting an interest. And at the end of the term of that particular instrument or bond, they get back their principal. I think there's also a term, equities. Equities are simply shares, and a share is a unit of ownership. It represents a unit of ownership in a company. So currently we have, she talked about the companies that are currently listed at the Ghana Securities Exchange, and among them are 9 domestic counters or companies. So ideally, as a member of the public, you can purchase part ownership, or you can gain ownership in those 9 listed counters or companies by buying a share, which is a unit of ownership in those particular companies. Now, turning back to my question, how is the regulator helping in as far as building financial resilience is concerned? One, what we believe is that an informed public, okay, once you're well informed, once you're aware of the different investment products that are available, then you're in a better position to make sound financial decisions. So as one way of trying to build that financial resilience, we're engaging in public sensitization exercises. And this webinar is actually part of that campaign of trying to raise awareness. So you have an informed public, and once the public is better informed, then you do expect that sound financial decisions will be made. And as a result, people can build back better. In addition to that, the Capital Markets Authority is a government agency charged with developing and regulating Uganda's capital markets. So we are a regulator. And being a regulator, our core mandate lies in protecting investors. Our core mandate lies in ensuring that those who provide these financial products are actually regulated, they're licensed, approved, or authorized. We undertake background checks on these individuals. We vet them to ensure that they're sound before they provide these financial products or financial services to the public. So as one way of ensuring that people build back that resilience, or the public builds back the necessary resilience, we ensure that those playing within this particular space are regulated, they're known. We've done background checks, and once people start saving in order to build back their resilience, they're protected, or their savings are protected. And we've come out time and again to caution Ugandans against unlicensed, unauthorized, unapproved, and unregulated products. And usually during times of crisis, when you have a crisis, people are desperate. People are looking for ways of, generating a return, generating an income. It's easy for them to fall prey to unregulated schemes, unapproved schemes. Okay, so we always come out, and we've come out strongly, urging members of the public to ensure that they only deal with licensed, authorized, approved, and regulated players. They only deal in products that are licensed and approved by the Capital Markets Authority. And the beauty about dealing in a regulated product, or saving through a regulated product, is that in the event of anything, then you have recourse. There's recourse for you as an investor. The authority can take up your case with much more ease if the parties involved fall within its regulatory ambit. But in the event that they don't fall within the regulatory ambit of the authority, then it gets very difficult to address issues. So it's important that you invest in a regulated product as you try and build back your resilience. We're going to continue educating members of the public. And we hope that will pull through this particular, health crisis that has morphed and evolved into, some sort of crisis with an economic bearing.
Well, thank you very much, Dixon Sembia. He is the Director of Research and Market Development at the Capital Markets Authority. Let's also bring in Alan Wetaba, the Head of Reserves Management at the Central Bank, Bank of Uganda. Let's talk about the importance of saving and investing. Yes. Very good morning once again, Alan Wetaba. Are you live with us? Yes, Alan, what are the key lessons that this pandemic, COVID-19 pandemic, has taught us about the importance of saving and investing? Mr. Alan Wetaba.
Yes, I am. Thank you very much for that question. If we go back to our topic for today about building financial resilience, it sits at the heart of what we are discussing today about saving, but it's not enough to save. For you to build your resilience, you need to be able to invest at the same time. So there is always two decisions that need to be taken. There's a decision to set money aside from your monthly income. Set some money aside. The Bible recommends 1/10 of your saving for tithe, but another 1/10 for saving. But what happens to the 1/10 that is available for you, or that money you have set aside? The next decision you need to be making is investing that money. If we recall the parable of the 3 talents, the master was not happy with the servant that was given an asset to manage and did nothing. So it's important to balance setting money aside and investing it. Investing it is what makes your master happy, because it allows money to grow faster. It allows you to accrue interest. And even the Bible is actually very interesting. The master highlighted that he was unhappy with the servant that kept the money and did nothing, because at a minimum, the servant could have given this money to money changers to earn an interest, which is very important conversation for us in this day and age, that still the Bible and even us today, we still recommend that individuals, families, and households, if they must set money aside, and when they set money aside, they should provide it to a professional, a money manager, a licensed manager, who then is able to grow this money faster. As this money grows, the individual, the family, will be able to increase their resilience, because they will be having more and more money set aside for future disruptions, for future unforeseen expenses, and these will be easier to manage the next time around. And that's the importance of balancing savings and also bringing on board investment. And so we are happy. A lot of our members in the CFA Society are professionals. A number of our members are licensed, and they are capable and able to advise individuals, institutions, pension schemes on how and which avenues are available for you to invest in going forward, and how best do you protect your money, but also allow it to grow in a more functional, logical manner. Thank you.
Alan Wetaba is the Head of Reserves Management at the Central Bank, Bank of Uganda, and we are talking about rebuilding financial resilience in a post-COVID-19 environment. What are capital markets, and how can capital markets be used to ensure resilience building within the citizens of our country here? How can we reduce on the losses that have been incurred since the onset of the pandemic, and how can we ensure growth of the savings all the same, so that our individuals in this country can build resilience? Let me also bring in Mr. Ayiko Ongodi, the CEO and founder of Zeno Investment Management Uganda Limited. Let's talk about the Ponzi schemes. Wow. Ms. Aiko, many people are falling for these Ponzi schemes, which promise higher returns. What are we going to do about it?
Excuse me. So that's a very important question, and there's many ways to answer it. One way is just remembering, typically when you have some money that you need to put to use, who do you ask for advice?
Yes.
You ask your brother. You ask
the nearest person in your vicinity.
The nearest person. You ask your sister. You ask your mom. You ask whatever. Yeah? But do they actually have the experience, the training, the expertise to advise you on how to invest that money?
The goodwill, yes.
Sometimes,
The
yeah, the
expertise, no.
goodwill, their heart's in the correct places, yeah, but they might not actually be giving you the correct advice.
All they'll say is go for it, go for it.
Yeah,
They'll
go for
egg
it.
you on.
Yeah. Oh,
Good or
I
bad.
hear there's an expression in one of the local languages. Enobifuna chilaru. Yeah.
There you go. All right.
So it's very important to know who are you taking this guidance from?
Indeed.
Who are you taking this investment strategy? Who are they qualified? Do they have the experience? Okay, these products that are they are proposing to you, do they actually make sense? When a person says, "Oh, you can earn 10% per month," okay, very, very important. And I'm going to make the second point. So, first point is ensure that whoever is giving you guidance actually has the professional. Of course, the heart is in the correct place, etc., but actually has the professional competence to give you that guidance. I would advise typically if you don't, if you need guidance about how to save for your child's education, how to invest your lump sum that you've acquired, use a professional, licensed and regulated investment advisor, investment manager, licensed and regulated by the Capital Markets Authority. The second thing that I want to make in regard to Ponzi schemes and the like, usually people make investment decisions based on returns alone.
I understand.
That you only, if you have an asset A that earns you, say, 20% per year,
I hear that.
and then asset B that earns you 15% per year, the normal person, the average person, like you and me, the ordinary person, not the ordinary person might actually say, "Oh, give me the 20% per year. It's the better one."
I see.
But you've only used half the information you need to make that decision.
That's where the CIS manager comes in.
This is where an investment professional comes in, because the asset that's earning 20% would be the preferred asset on condition that both assets have the same risk. If they two have a different risk, the decision is slightly more complex than that. So that's one thing about that. The third thing that I want to make is, but what is a normal return? So if you have some money that you want to put to work, you want to invest, yeah? There's something called a risk, in every country there's something called a risk-free asset. So a risk-free asset is typically the benchmark that you reference every other investment opportunity to. Because it's a risk-free, remember when you're investing, you're taking money that's already in your pocket.
Indeed.
You're taking money that's already in your pocket, pulling it out and then risking it. You're undertaking risk, yeah? So you need to be rewarded for it. But if you're able to get an asset that has no risk, what would the return be? The typical asset used in most countries is the one-year treasury bill. So if I want the audience to take away anything from today's discussion,
Sharpen your ears.
what is the one-year treasury bill yield? That's the risk-free return.
I hear you.
Anything else that you're going to invest in is riskier than that, and so should reward you relatively higher than the one-year treasury bill.
Let's talk about risky investments. The people in the investment clubs, they have their own leadership, which helps them make the investment decisions. So they invest in real estate, which has largely been hit by a 30% rental income tax. So the landlords are grappling. They've been hit in the transportation sector. You have an inter-travel ban, so they've been hit and they're losing money. You also have the agricultural sector where they invest money, and the inter-travel ban is also affecting agriculture. Don't you think these investment clubs would have been in a better position if they had employed a CIS manager to help them make a better investment decision?
Robin, let me sneak in to complete an answer about Ponzi schemes. So a lot of people chase returns instead of chasing the goals.
Yes.
Why are you investing? Instead of chasing, just remember, you're investing for your child's education.
Indeed.
Focus on that. And what do you need?
Not the returns.
Not the returns, because returns, the decisions are slightly more complex to make when only returns are used.
Indeed.
But then let's go to your, so that's why people fall for high earning, supposedly high earning Ponzi schemes a lot.
Indeed.
And so it just remove the focus from the returns and focus it on the goals might help in some way. Investment clubs that, so the regular investment club is formed in a bar, yeah, you guys meeting and you're happy.
Come up
you
with
know,
an
we
idea.
all earn some money. Let's put together, let's chuck in something every month, etc. Yeah? But then, of course, that's the feel-good phase.
Yes.
Where the rubber hits the road, now you've chucked in some money. Now, where do you deploy this money? So a lot of people, oh, a car wash, yeah? People make money in the car wash. But then grains over there in Sironko or whatever it is.
Yeah.
There is a grain trading thing that you can do a margin of 60%. And so you find people that are regularly employed have their main source of income is a regular job or some regular business, are now getting involved in grain trading, in car washes. Of course, it is okay. I mean, absolutely somebody needs to do that. But a lot of the time, these enterprises have significant supervisory effort that is required in order. Farming.
And time, yes.
Yeah, farming. Time. And a lot of these people don't have
They have
time.
side businesses.
They have their regular jobs. Yeah, and you can't run that. This requires quite a bit of time, so it becomes very, very inefficient.
That's where you come in.
This is where an investment manager that executes these investments, giving you exposure to a broad range of assets, comes in and executes those using unit trust funds. One of those investment managers is Zeno Investment Management.
Indeed, so if you need any financial insights on the same, look for Zeno Investments and Management Uganda Limited. Also look for UAP, Old Mutual Financial Services Limited. You also look for ICAA, Asset Management Uganda Limited. Also look for Sanlam. Also look for Britam Uganda Limited. All those are the certified, 5 of them, certified CIS managers in Uganda, courtesy of the Capital Markets Authority. Let me also bring in Ms. Sarah Katuramu. She is an investment analyst with Jane Africa Asset Managers. Yes, a very good morning once again. Is it afternoon already? It's midday, 1 minute past. A very good afternoon, Sarah Katuramu. Let's talk about recommendations. Would you recommend a loved one to invest?
When you say would, it's funny because I feel like it's all I do. My family can attest that I am always trying to get them to invest in the markets. If COVID has taught us anything, it's the importance of saving. You can't know what tomorrow will bring, so it's always nice to have some money put aside for a rainy day. So I would recommend, especially when the yields were great on the bonds around last year, I would recommend people, please buy these bonds. They're very liquid assets, so whenever you have a problem, you can sell it back to the bank easily, get your money back, solve your issue, and they're just and they're easy to access, right, when you're initially buying. I would get into the whole primary market, secondary market, but let's leave that alone. They're easy to sell, and you get back your money. And for the people who said that, oh, I don't understand this whole bond thing, I would recommend hassle-free investment in collective investment schemes, because they were prioritizing the preservation of funds and trying to manage the exposure to risk. So I would recommend collective investment schemes or the unit trusts through the providers that you have listed. And always make sure that when you are looking for where to save your money, you have to look at the capital markets website to make sure that these people who are providing these services are listed and are licensed.
All right.
Yeah.
All right. Now I'm starting to earn. Yes. Okay, let's just say I started yesterday earning some money. What advice would you give me?
Do not, in the beginning, people feel like I'm making very little money, so what should I can't start saving now. No, but start immediately. The moment you start earning, even if it's a 5 or 10% off the money that you're making, just put it aside. Listen to, people are field agents that come and they represent unit trusts. Listen to these people. They do have something to say. And because you could have some little money, it will work well together, because these guys pool the funds as they invest them. So start saving, save consistently, because discipline is what makes it it's what makes it worthwhile eventually.
Should I concentrate on saving first and investing later?
No, you can, as these guys do, right? Saving can be coupled with investments. So you're putting money aside. It's like a monthly contribution that you're making.
I see.
But these contributions are being invested, and a return is coming, and you're making more money at the end.
All right, my panelists have wealth of information pertaining to these particular conversations. Sarah Kataramo, Ms. Ongodia Ayeko, Mr. Alan Retaba, and Dixon Sembuya. Very good afternoon, Mr. Dixon Sembuya. Let's talk about the future of the industry before I let you go. Paint for us a picture. Mr. Sembuya, paint for us a picture of the investment industry. What does it look like?
Good afternoon once again. And colleagues, once again, allow me to thank you all for your insights. And, thank you a lot for unpacking and breaking down, the whole saving and investing concept, and specifically in this case with regards to collective investment schemes. Now, allow me to also respond to, before I go directly to my question, I'd also like to touch on something that you and Sarah were discussing, and that was on the issue of, saving coupled with investing. I think if you save without investing, the danger is that the value of your money might get eroded. I think price levels rise with time. And so saving without investing might actually erode the value of your investment. So it's important for you to save and invest simultaneously. And the beauty is that with the products that are available, specifically in the collective investment scheme space, you can actually save very little amounts. You can save from 100,000, 10,000, you name it. So in as far as being able to save and invest is concerned, the entry amounts are low, and almost anyone who wants to save is encouraged, to use this particular avenue to save and invest. Now, on trying to paint a picture for, the collective investment scheme sector or the investments industry, I think the future is bright. We have barely scratched the surface. As I'm speaking, the collective investment scheme industry has been able to mobilize roughly 500 billion shillings in savings from Ugandans. But we envisage that in the next 3 to 4 years, we should actually be able to double that amount to about 1 trillion shillings. And that will be done through continuously sensitizing Ugandans on how to save and invest through this particular avenue. So the future looks bright.
All right.
It's important that we cultivate that culture of savings, and the collective investment scheme is an appropriate vehicle in as far as trying to cultivate, that culture of savings among Ugandans. And the beauty about all this is that it has economic implications in the sense that what you save through this particular investment vehicle is actually deployed as capital to stimulate the growth.
All right, thank you very much, Mr. Dixon Sembuya. I'm afraid we've run out of time, and we still have Mr. Alan Retaba, whose submission we haven't heard. Mr. Alan Retaba is the head of reserves and management at the Central Bank. Mr. Alan Retaba, paint for us a picture, an outlook for the economy. And don't you think the returns that we are talking about right now will be eroded by the rising inflation? Mr. Retaba, take it away. Outlook for the economy, and won't the returns be eroded by rising inflation? In the 1 minute that is left, please expound more.
I think this is a trick question. You're trying to blanket me somewhere in between. But I'm happy to say that the picture is very bright. Inflation is likely to stay very low. It is expected to stay within the central bank's band of 5%. over the next few years. And I think we saw that in the report that the central bank released in the last couple of days, the MPC report. I think the picture is still positive on inflation, that it will remain low. And that means that investments in bonds will remain a very good investment over the next couple of years. And we have also seen that government is still doing a lot of activities. From where I'm sitting, I see a lot of infrastructure development. Some roads are being done. I see areas of redevelopment. So all these mean that government will still have or need to come to the market to raise financing. And so there are still many investment opportunities for investment clubs, for SACCOs, for individuals to participate in, and these opportunities will not disappear immediately. We also see that the economy is about to pick up. We are hopeful on the post-COVID environment that things will be better. Companies will be able to operate. Many of us will be vaccinated, and that the economy will open up and will get back to a semblance of normality. When that happens in about 6 months or so, we will see that even equities, stocks will do well. Companies will be able to make some money as the economy comes back to life. And so when I look forward over the next 6 to 8 months, I'm hopeful that investing is going to be the game in town. And I will encourage anyone who is interested in doing this to reach out to us to see how we can help them navigate the markets. Thank you very much, Remy.
We've been having largely centered around rebuilding resilience in a post-COVID-19 world. My name is Romeo Bisiku. Special thanks to our panelists, 4 panelists with whom we are compounding on this conversation. Sarah Katuramo, an investment analyst with Gen Africa, yes, asset managers, and also Mr. Ongodia Aiko. He is the CEO and founder of Zeno Investment Management in Uganda Limited. We also did have Alan Rwetaba, the head of reserves. Yes, there he is. Management at the Central Bank of Uganda. And finally, Dixon Sembuya, the Director Research and Market Development at the Capital Markets Authority. Many thanks to the viewers who have been watching this show. Please save, 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 invest the money, and when you get the returns, save them again. Don't eat the money. My name is Romeo Bisiku. Good afternoon.